So the contents of this video are going to be in line with the UST Luna video that you may have already seen. Now, you may recall from last month we discussed fractional reserve banking and systemic fragility. So this is really in line with that. As a quick recap as to how fractional reserve systems can introduce fragility into monetary systems, you can review this article. It's a quick overview of this. And of course, some of the papers that we linked in the previous month were much more detailed than this. But basically, what you'll notice from these articles that we've curated here is how the role that stablecoins play and how they are, interestingly, very similar to fractional reserve fiat assets within the legacy financial system is very, it's noteworthy. And actually, we think that some of the fragilities that have really surfaced recently, not just with UST, but also with the sort of the deviation of the peg with both USDC and USDT is indicative of this. Some of these non-algorithmic stablecoins do run on fractional reserves. And what's interesting is that you'll notice while these articles are not from this year, so this one's from 2020, and then the next one's going to be from 2021. This has been postulated since basically a few years ago, and really since the inception of the crypto space. Um, and it's interesting because they're both necessary in the same way that we may think fiat assets are necessary to facilitate um, modern economies. However, the fractional reserve aspect of them, while they do avail, expansionary monetary supply, a net expansionary monetary supply, I should say, they also introduce systemic fragility. So you should certainly check out this article. It kind of goes over that and why. At this point, it was just postulated that this may be the case. And then, of course, by 2021, when Iron Finance actually collapsed. This is one of now many projects, especially in recent history, that have collapsed. And granted, it is not, none of these no many of these algorithms or many of these stablecoin projects are not the same in terms of their backing, their peg, and how, whether they're algorithmic or not. They do have their centrality does play a role in systemic fragility and hegemonic risk when it comes to crypto assets and really just the crypto economies in general. And yeah, so this article again from 2021. This will, if you review this, you'll notice this goes over Iron Finance and how it essentially collapsed. It was also a algorithmic stablecoin. There's also reference of Mt. Gox here, which many of you may recall from your own crypto trading or from some of the videos we recorded, I think a quarter or two ago. And then the last thing we've linked here is the financial stability report that was recently issued by Congress. I'm sorry, the recently issued by the Federal Reserve, specifically going over the stablecoins. So interestingly enough, the Fed is also privy to, of course, not just stablecoins, but how they are increasing the risk vectors for systemic risk, particularly by way of the fact that they are on ramps for an ever increasing crypto economy. So definitely recommend if you have the time to review parts of this article. I think they start to really dig into bank runs, or in this case, stablecoin runs, and how that may have an impact on the space. As you all know, at this point in time, of course, a run did take place with UST, and this, of course, poses some serious considerations or reconsiderations, I should say, for how algorithmic stablecoins are issued. As always, if you have questions, I certainly encourage you to reach out and we'd be happy to discuss. Thanks.